Ray Dalio reveals shocking new predictions that include the dollar collapse. So I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's start with money printing. And of course, in today's day and age, 2020, it always seems to start with the Fed's money printing. And we're not going to get into the details as to whether or not the Fed can create broad money, M2 money supply, chasing goods and services in the real economy. We're going to stick with the basics, and that's the Fed creating bank reserves out of thin air to buy financial assets, more specifically treasuries. So the Fed comes in, they print up all of this funny money literally by going to their computers and typing additional digits in the reserve accounts of the entities they're buying the treasuries from. Mostly primary dealer banks, commercial banks, sometimes hedge funds and financial institutions. These hedge funds and financial institutions might not have reserve accounts, in which case the transaction would go through their commercial bank. But that's getting into the weeds a little too much for this video. The bottom line is the Fed creates bank reserves, funny money, goes into the treasury market and buys the treasuries from the banks, the financial institutions, and hedge funds. So those treasuries go to the balance sheet of the Fed. They now own those treasuries. They've created additional demand, maybe even excess demand. Well, we know if demand goes up, then typically the price goes up as well. And there's an inverse relationship between the price of a treasury and the yield or the interest rate. So if price goes up, the yield or the interest rate goes down. And the yield is what you're being paid to own the specific treasury. So theoretically, the lower the yield goes, the less attractive those treasuries are compared with other asset classes. And to dive into this deeper, let's go to a recent interview with Bloomberg and Ray Dalio.
Fiscal deficits and money printing, we've already seen some of the impact, at least some of the impact in financial markets of all the massive fiscal spending and all the massive monetary stimulus, stock prices at record levels, negative real yields on treasuries, negative nominal yields on sovereign debt around the world. Where does it go from here, Ray?
Well, first, I want to convey the mechanics of that. When there's more, you run a larger deficit, and there's printing and buying of financial assets. It drives down real yields, and as a result of this, it drives money into alternative assets. There's a supply-demand problem for bonds, but when the central banks at the end of the day print, in much the same as Roosevelt did in March of 1933, that causes financial asset prices to rise and supports the economy, but diminishes the value of debt, the real value of debt.
Now let's go over some charts that illustrate what Ray was talking about. We start with the Fed's BS, or their balance sheet, going back to 2008 all the way to 2020. On the left, we go from $0 over $6 trillion. So before quantitative easing 1 in the GFC, the Fed's balance sheet was about $800 billion, pretty consistent. Then we get to the GFC, quantitative easing 1, it goes parabolic and keeps going up and up and up until it maxes out about $4.5 trillion. It stays pretty consistent until we get to about 2018, where the Fed tries QT, or quantitative tightening, the reverse process where they start to sell treasuries and mortgage-backed securities. They continued this process all the way till September 2019, and you know what happened then. That was the repo market debacle, where interest rates went way up over 10%, and the Fed had to step in, create more funny money, more bank reserves to get those interest rates down so the entire system wouldn't collapse. So their balance sheet goes up, even though they're calling it not QE. They said, whatever you do, don't call it QE, but magically their balance sheet continue to go up. And then we get the cerveza sickness, it goes parabolic to now it's over 7 trillion. And I've got your friend and family member Fred here, and of course he's holding a sign that says, "I love the Fed." And this is just to remind you that the mainstream media, CNBC, Bloomberg, pretty much everyone outside of the individuals like you who are smart enough to watch the George Gavin YouTube channel, think that the Fed saved the day. They think the Fed's the firefighter, where we know the Fed is really the arsonist. So let's go to the second chart, and this is of the 10-year Treasury, going back to October 2019 all the way to August. The interest rate 0 up to 2%. Back in October 2019, we're humming right along about 1.5%, gradually going up. And then we have a decline when we start to get the news about the cerveza sickness. When the Fed comes in and starts QE infinity in March, that's when interest rates drop off a cliff. This would coincide with this chart, and that's where the Fed's balance sheet goes parabolic. So again, what's happening is the Fed is coming in and buying treasuries, and according to Ray Dalio, that additional demand is making the price go up or the interest rate go down. So we've got additional buying, additional demand, additional price, interest rate goes down at the same time. And I want to be very clear. This is how Ray Dalio sees it. I'm explaining to you what he's talking about. And it's really consistent with how the mainstream media describes it as well. But it doesn't mean that it's totally accurate. I don't want to get too far off on a tangent, but I want to point out that my good buddy Jeff Snyder would say, no, that's not the way it works. Just because the Fed comes in, creates funny money to buy treasuries, doesn't necessarily mean that the interest rates go down. I don't want to put words in his mouth. He's a heck of a lot smarter than I am, but I would guess that Jeff would point back to the repo spike in 2019 and say, hey guys, look, the Fed's balance sheet went up there and interest rates didn't collapse. In fact, they stayed steady and gradually went up. So I don't want to go too far down that rabbit hole, but I do want to make sure that everyone knows watching this video that I'm describing the world through Ray Dalio's eyes. I'm not necessarily saying that's the way it is. That's definitely an open debate. But the main takeaway from step number 1 is the Fed is coming in and creating additional bank reserves, printing money, in other words, to buy treasuries. And Ray believes that creates additional demand for those treasuries, which increases the price and lowers the interest rate. And it makes this asset class a lot less attractive relative to equities or gold. More on that in step number 2. Step number 2, could the dollar lose its reserve currency status due to the process we discussed in step number 1? Ray Dalio says yes. Editor, let's go right back to the Bloomberg interview.
We're dealing with a situation like in the 30s that could be threatening even to the reserve currency status. In any way, it diminishes the value of that which is being produced. That means money and credit, and it drives money into those other assets. So it's that kind of market action.
Is there a real threat right now to the U.S. dollar's status as the world's reserve currency?
Yes, there is a threat. It's an evolutionary type of process. There's not yet a good alternative in the form of a currency per se, but people are not, investors, big, large institutional investors, don't run out necessarily to alternative currency because the 3 major reserve currencies all have the same basic problem. That's why they move into a new storehold of wealth. And you see that the storehold of wealth, like in 1933 reaction, is equities, is gold, is other asset classes that go up.
So what Ray Dalio is reminding us that if you're the average Joe or any entity that owns a 10-year treasury, a 30-year treasury, basically you're owning long-dated dollars. That's right. If you think about it, you're just owning dollars for a long period of time, and the government, your drunk, insolvent Uncle Sam, more on him in step number 3, is just paying you an interest rate or a yield that's decreasing due to what the Fed is doing by buying those treasuries, creating excess demand. And to Ray's point, if you look around the world and try to find another safe haven asset, you're not going to do it in Japan. They have negative nominal interest rates. You're not going to do it in Europe. They have negative nominal interest rates as well. And you come to the United States, it has positive nominal rates, but when you adjust for inflation, their rates are negative as well. So let's think this through. Going back to the chart of the 10-year Treasury from 2019 to August of 2020, it started off at about 1.5%. When they came in and did QE infinity in March, those interest rates went all the way down to about 0.5%. But let's keep in mind that the Fed has come out and explicitly said that they're trying to achieve 2% inflation, if not higher. So if you've got the bar set at 2% or higher, and the interest rates are at 0.5%, you have a negative real rate. In other words, if the average Joe buys that 10-year Treasury and holds it to maturity, they are guaranteed to lose money. Or as one of my favorites, Jim Grant says, you've got return-free risk. So the historic safe haven asset, the 10-year Treasury, doesn't look so safe anymore. So what do the investors do? They might go into equities. It has a little less inflation risk, or I think you can read my mind, they go right into gold. So editor, throw up a chart of equities and we can see that they have definitely gone up since March and quantitative easing infinity. And gold, as we all know, has been going up even in 2019, but has gone almost parabolic since March of 2020. So in Ray's opinion, what's happening is the investors are looking at the 10-year Treasury and saying, listen, no thanks. The rate we're being paid to hold them is far below the target inflation rate of the Fed. And of course, all of us would argue that this is even dramatically understated. So when you've got inflation running higher than the interest rate you're being paid, plus the Fed is coming in, increasing demand, increasing price, and then dropping those interest rates even further, those 10-year Treasuries don't look so good. We go into equities. More so, we go into gold. So if you believe that the Fed is going to continue quantitative easing, continue money printing, you definitely want to own some gold. Step number 3, the dollar endgame according to Ray Dalio. Like we said in step number 2, Ray believes that the average Joe, the hedge fund managers, the financial institutions, all of these entities holding treasuries, 10-year treasuries or government debt, are going to realize that they have long-dated dollars. And they're going to look at this and say, we don't want anything to do with it, when real interest rates are actually negative. Because this is return-free risk, meaning there's no way that we're going to make money. We are guaranteed to lose purchasing power over the long run. So all of the entities are going to start selling their treasuries. They're going to rotate into a different asset class, such as gold or precious metals. That's going to increase the supply in the bond market. At the same time, this guy, your drunk, insolvent Uncle Sam, is making it rain down on the real economy with stimulus checks and deficit spending. This puts the Fed into a very difficult position. For more on that, let's go right back to the Bloomberg interview with Ray Dalio.
If that gets too far, and it's standing the risk of, it's very dangerous. It looks like a currency defense. In other words, if those who are holding bonds, which are a lot, choose to sell the bonds because they're not providing a good return, and they're not, and because there's so much debt production and debt monetization, that puts the Federal Reserve or other central banks in the very difficult position of operating like a currency defense. Mechanistically, as money leaves that debt, that means either interest rates would rise, which would be terrible for the economy and markets, or they're forced to buy more and more. And that is how a spiral could occur.
So the supply of bonds hitting the market increases, which makes the price of those bonds go down. And remember, there's an inverse relationship between price and yield. So if prices are going down, yields and interest rates are going up. But Ray knows the economy cannot stand higher interest rates. If interest rates were to go up, the economy would collapse. So the Fed has to come in and buy all those additional treasuries that the government is creating by your drunk, insolvent Uncle Sam's deficit spending, along with the treasuries that are being sold by the entities that see them now as a hot potato. The Fed has to monetize the debt, meaning they just have to print up more and more bank reserves, as many bank reserves as possible to buy those treasuries to make sure interest rates don't go up and crush the economy. But this takes us straight into a doom vortex. The more the Fed monetizes the debt, the more the marketplace sells the treasuries. The more treasuries the marketplace sells, the more the Fed has to monetize the debt. So the next question becomes, okay, George, well, I get what you're saying, but maybe the government deficit spending isn't going to be so bad. Maybe it's going down. Not even close. The deficit is going the opposite direction. We've got a chart going back to October 2019 all the way to September 2020. And the expected deficit of the government is tracking right along at about 500 billion. This chart goes from 500 billion up to 3 trillion. But we get to March and you can see that deficit start to go parabolic, almost straight up, till we get to where we are today. And even the government's own projections of what their deficit is going to be is over $3 trillion. And we're not done with the year. I would expect they're going to come out with another stimulus package that's going to take the deficits to infinity and beyond, straight to Buzz Lightyear territory. Just to give you some context, the deficit that the government will run in 2020 alone, just for this 1 year, is going to be close to the entire amount of debt the government accumulated from 1776 to the year 2000. Let that sink in a bit. So the bottom line is Ray Dalio sees deficits going through the roof, the Fed monetizing and printing money to control the yield curve. You've been hearing that a lot, yield curve control. All the Fed people are saying it in almost every speech. And the only release valve for the money printing, the debt monetization, and controlling the yield curve or keeping interest rates artificially low is going to be the US dollar. And that's why Ray Dalio sees the US dollar declining and eventually losing its reserve currency status. For more content that'll help you build wealth and thrive in a world of out of control central banks and big governments, check out this playlist right here, and I will see you on the next video.